You're watching BCTV. We're all about Branford.
I don't recall ever seeing this in these documents.
You're watching BCTV, Branford Government Television, a service of Branford Community Television. This program is brought to you in part through the support of the town of Branford.
Okay, we're going to get started. Board of Finance meeting, Town of Branford, November 26, 2018. First on the agenda is to approve minutes of the September 24th, 2018 meeting.
I'll move we accept.
Second.
Motion's been made and second. Is there discussion? All in favor?
Aye.
Next on the agenda is citizens' comments, citizens' communication. Ordinarily, we'll take comments from the public on agenda items. Are there any interested parties? With no takers, we'll go on to agenda item number 3 to hear a presentation from GYL Financial Synergies and Hightower Advisors regarding the town's police pension plan for the quarter ending June 30th, 2018, and if necessary, rebalance the portfolio. And we'll also hear with regards to the volunteer fire, as well as the OPEB, Other Post-Employment Benefits Trust. Welcome, gentlemen.
At the full force here.
Okay.
So, good evening. I'm going to kick things off for our presentation tonight. First thing I'm going to cover is a little bit of a recap of the market experience for the reporting period. And the reporting period is for the period ending September 30th, 2018. And Michael will cover the actual experience of the various funds, the police pension, the fire pension, the OPEB trust for that reporting period. Additionally, Charlie is going to provide some commentary that talks about the current market conditions we've experienced over the last several weeks. And Luke will also help us with some of the allocation details as we go through this. So with regards to the market experience in the third quarter of 2018, it was a positive equity market with U.S. equities outperforming international and large U.S. equities doing better than small. So where we saw the S&P 500 up just over 7.5% for the third quarter, and small company stocks up about 3.5%, while international markets were arguably flat for the quarter. For the year-to-date period ending September 30th, the S&P 500 was up about 10.5%. Small U.S. companies were up about 11.5%. International markets, the developed international markets, were slightly negative, and the emerging markets were down about 7.5%. So it was quite a mixed bag of equity markets for the year as we look through the period ending September 30th. As well, we saw interest rates continue to rise on the short end of the yield curve controlled by the Federal Reserve. At the same time, over the last quarter, we saw the longer end of the yield curve stay fairly contained, so the yield curve has continued to, as you can remember from past presentations, the yield curve has continued to flatten or stay fairly flat. And what we refer to there is the difference between the 2-year Treasury and the 10-year Treasury is roughly about just under 1/4% now, meaning that the yield for a 2-year Treasury is currently at 2.83%, and the 10-year Treasury at 3.05 is roughly just under 1/4% difference, so the yield curve has continued to stay fairly flat. The economic data through the period has been healthy. GDP growth has been as expected, where we're seeing GDP plotting towards a 2.9% growth for the year. And the Fed's measure of inflation, the core PCE index that we commonly look at here, is approaching the 1.9 or 2% number, which is the target the Fed looks for, while unemployment has been staying well contained below 4% at this point. So overall economic data through the end of September looked very good and healthy. The equity markets led by the U.S., international markets are struggling, and fixed income has had interest rates rising a little bit, which has caused bond prices to decline slightly. And the high yield markets have held their ground fairly well through the end of the third quarter. So that gives you just kind of a quick encapsulation there. And then I'll let Michael jump into the return of the fund, or Charlie, do you want to talk more currently?
No, let me talk. Make sense for me to go next?
Sure.
Okay. So, that was through September, and what a difference a few months makes. We entered into a pretty volatile market. I wasn't surprised initially. I expected, potentially a 10% decline, a consolidation, of some significant gains. But the market seems to have been looking for an opportunity to go down further, and it did. Some of the catalysts were Chairman of the Federal Reserve Powell in an interview talking about, or the implication being increasing rates at a faster rate than the market was anticipating, or the market determined to be, reasonable. That was one. Two, it seemed as though expectations, we had a very good year, 2018, in terms of earnings growth for U.S. companies, and obviously that growth is slowing. So the question then became, with the market, how much is it going to slow, and is that a reason to sell? And sometimes, people are looking for an opportunity to sell. There had been some pretty big gains, and so we started to see that. And the markets are a function of human behavior and psychology, and they always go up higher than they should, and they always go down, farther than they should. So, my view is that we are, currently in a bottoming process for this current leg of the market. That I wouldn't be racing to add money to stocks, but I wouldn't be a seller where we currently are. The companies are healthy. Companies came in with earnings that were, pretty much higher than expected. Even the high hype technology companies, it was the guidance that was concerning. And sometimes companies in an environment like this will guide lower, because then they can come back in the next quarter or 2 quarters and beat, and that's and that can be very positive. So I don't think there's any reason to panic based on what we see happening. I think there'll be continued volatility. The market was up, significantly today. No apparent reason for it other than this is kind of the way markets work, and we want to see it test the recent lows and continue to do that for a period of time. I don't think there's going to be a V-shaped advance in the market, so it's going to take a little bit of time to work its way through. Deeper than expected, but not unhealthy at this point. So, anybody have any questions?
Mr. Charlie, do you think the recent sell-off that we had anything to do with like a typical December sell-off, or they sell off and buy back a month later?
You mean tax loss selling?
Yeah.
There's always a little bit of that, but this happened well beforehand. And there's there were a lot of gains out there, so they would have been taking gains, not losses. So I don't think that was necessarily a big factor. The situation in China is a factor. The uncertainty of knowing what the trade policies are going to be is a factor. On any given day, you can get a lot of different messages coming out of the White House, and whether they're relevant or not relevant, it doesn't matter. The the markets react to. They would rather have calm and calm and steady as opposed to rhetoric that's all over the place, or controversial. So, I think there's a lot of factors that created this. I call it a correction. If you go on CNBC and you're paid to, sell advertising, you're going to raise your arms and scream and yell, and you're going to have all these pontificators. But that's not our job. Our job is to sit and thoughtfully look at things and report to clients. And so, at this point, I don't see any reason to dive into stocks, and I don't see any reason to liquidate or reduce the allocation.
So as far as the board's responsibility, you're saying we should stay the course?
Yes, I would stay the course. The policy that we put in place is founded in in very reasonable, with very reasonable factors. When we forecast out what you need, and using conservative assumptions about returns, we're in good shape. So it doesn't make sense to make any meaningful change in the current allocation. The policy, you really want to follow the policy, right now, because of the decline, we're a little overweighted in fixed income, which if we were robotic about how we approach this, would mean sell fixed income and buy stocks. It doesn't make sense for us to do that at this time. We'd rather take a more conservative approach, and also, just my view is it doesn't pass the test of reasonableness to make a change there.
Thanks, Charlie. Mike, you want to go over this? It's a little outdated, but you're welcome to carry on.
Absolutely, I'll be brief.
Please.
Starting on page 19, please, of the police pension report. And so we'll start looking at I think, especially given the sell-off we've seen in the market over the past 8 weeks or so, as Charlie alluded to, now's really the time when you want to take a long-term view. And I think on page 19, this does exactly that. If you look at the top right on page 19, about 4 rows from the top, you see the annualized return going back to 4/1/03 at 5.77%, spot on with the policy. So that translates to a total return of 138%. And that's come with about 9% less volatility as defined by the portfolio beta. So going back to inception, we've essentially met the return of the benchmark, but done so with about 9% less volatility. So all in all, that's a good long-term metric. What that means in dollars and cents is at the bottom right of page 19. You can see beginning value at $8.3 million. As always, ignore the contributions and withdrawals because that includes rebalancing activity, and focus in on the net cash flow, about $1.9 million more in contributions made above and beyond benefits paid. And then just over $14.5 million as of earnings as of the end of September. Of course, since September, the market has moved against us, and I'm back on page 16. But the value at the end of September was $24.8 million. Since that time, there have been about $322,000 in withdrawals, basically for benefit payments, and then the market value has declined by about $1.32 million, which is roughly, using back of the envelope math, is about 5%. Brings us to $23.2 million is the value as of November 26th. So it doesn't take into account today's move in the market, but it was accurate as of this morning. Big picture, the equity portfolio is performing consistent with its underlying benchmark, being that it's all invested in index funds. And the fixed income portfolio, we've seen a little bit of outperformance from Mesirow, even though fixed income's been challenged. The higher credit quality bias that the pension has in its investment policy, combined with Meserow's preference for credit research and essentially buying lower volatility bonds. These are the times when it adds relative value, and it has thus far. Even though we've seen some negative numbers for the 1 year, they've been able to outperform the underlying benchmark. As Charlie alluded to, we are a little bit overweight in fixed income, about 44.5% versus the policy, which is 42.5%. But as discussed earlier, we're given the current market conditions, we're comfortable with that slight overweight, so no rebalancing recommended this evening.
So Mike, the 42%, that's within the range of 40 to 65%. Isn't that the broader policy?
Correct.
Okay. And I know you may or may not know this answer, but does this beg the question with regards to active management of the equity side at all?
Well, I mean, that's a very interesting question. Certainly I think the passive approach has served this pension, well for many, many years. There is, an argument to be made that as rates rise, correlations will decline between asset classes, and that's typically when active strategies can add value. But certainly for the past number of years, really, especially since the financial crisis, it's been with very narrow leadership in the market. It's been very difficult to beat index funds, especially in the domestic space. Do you have any comments?
Yeah, no, so active managers have, significantly underperformed for a long time. There is the potential for some active managers to perform, better than the benchmark, and that's their job. So after underperforming for 10 years, they're probably anxious to outperform, in the future. Active management's more expensive. The index approach that we utilize is very efficacious, and but we can also be more nimble if we need to, using the index strategy.
Okay, Charlie?
I know you said we were, I think, somewhat overweight and fixed, and yet our policy range goes up to 65%. I mean, it seems like a huge range from 40 to 65%, and yet we were around 44%. So
Yeah.
why are we kind of overweight?
Well, you're overweight versus your target, which is 40% in, 45% in.
Okay, the target is 40.
Fixed income, right. That range there that goes up to was it 60 or 65% is kind of the
Broad policy.
the bookends, if you will.
Yeah.
That if you wanted to move outside of that, you'd have to change your investment policy. But I don't want you to, I don't want that to be interpreted that, the fixed income allocation sways by that much. It really doesn't. That's just kind of are the limits that you baked into your investment policy that would require a change if you went out of that. But
Do you show targets in here?
Yeah,
yeah,
That's the
Page 30, Charlie.
page
30, right?
20.
20, yeah, the targets are here. This is the policy range,
Right.
but that's really the target, the 42.5%.
Okay, I thought that was where we currently stood.
Yeah,
As of September 30.
No, current year at,
You're
yeah,
at 44.
42.3.
yeah, 44.
Yeah, but this was as of September 30th.
Correct.
Right, that's-
As of last night.
you were right on at the end of September.
Okay.
But here, because of the dip in the equity side, the balance is off
All right.
as a percentage of the total.
At the end of September, the policy, the the police pension was spot on 55%, and the policy was 55% for equities.
Okay.
As of prior close, the equity exposure was at 53.9%, which means that that difference is into the fixed income side at 44.6 versus the fixed income policy at 42.5.
Okay, I
Yeah,
get it.
and the range is there, in the event there's some
No, I
sort
get
of,
it.
some sort of
So
crisis.
you're going to have to change the whole structure.
Right.
Right.
But the middle column that says policy is kind of what we
Okay.
base all the underweight and overweight on.
Right,
Okay.
which is basically the target.
Yeah, exactly.
Okay, next.
Great, so moving on to the volunteer fire. Page 16, the value at the end of the quarter was $1.1 million. The return for the quarter was 2.15%. Since that time, there's been negligible withdrawals, about $8,000, and in a decrease in valuation from markets of $61,700. So that brings us to a value of $1,043,000. And so again, that represents a decline of somewhere in the 5 to 6% range since the end of the quarter. Very similar to the pension, asset allocation, your target is 42.5% to fixed income, and current policy, or current allocation rather, is 44.7%. So again, somewhat overweight to fixed income, but not so much so that we recommend any changes given the market environment.
Thanks, Mike. Any questions on the fire?
No.
Okay.
Okay, then moving on to the OPEB, which is the third tab. The OPEB we'll also take a look at starting on page 19, the 35,000-foot view. Since inception of 7/1/11, an annualized return of 5.68%, again, right on par with the investment policy, which returned 5.65%. That translates to a total return of 49%, and that has come with about 24% less volatility, as indicated by the portfolio beta. So again, essentially 100% of the return of the benchmark with nice muted volatility by about 24%. In dollars and cents at the bottom right, beginning value you can see was $4,030,000. Since that time, about $8.5 million in contributions, $3.9 million in earnings, bringing us to the $16,434,000 at the end of September. Since that time, no withdrawals to speak of, and $870,000 in decline from market movement, bringing the value as of last night to $15,554,000.
And while we've talked about the market decline, also the percentage return market decline from September 30 to now, the S&P 500 is down roughly 10% for that period. So hopefully it gives you some perspective as to these funds being down roughly 5 or 6% for the period, and the broad market is down 10.
Thanks, Michael and Robert. Charlie, you got a question?
Is there another Fed rate increase expected before the end of the year?
December is the, consensus is there'll be a quarter point in December.
Okay, quarter point.
And possibly one in the first quarter.
Okay. Other questions to these gentlemen? All right, thank you.
Thank you.
Pardon?
Number 6.
Number 6, okay, good. Still got you. Okay, number 6 is to review and discuss recommended changes to the OPEB target allocations and return assumptions. Okay, gentlemen.
Okay, I'll
Jim, you gonna
yeah, I'll
kick
kick
that
this
one
off. Basically, about a year ago this time, we were looking at the pension plans, and we were looking at the returns, and we had a discussion with the board about looking at our rate of return assumptions. So last winter, we did some analysis, we had multiple meetings, and we made some changes to the pension plan. So we lowered our return assumption to 6.5%. While we were doing this, we had also mentioned that we would take a look at the other post-employment benefit trust. And essentially, we did that. We had some, all of us met, we had some conference calls, and to be consistent with the pension plan, our recommendation to the board is that we lower it from 6 3/4 to 6.5%. Echoing the sentiments that were said here tonight, when you look at our overall allocation, you know, the 55% equities to 45% fixed income and others, that really isn't changing. But we wanted to look at, if we're going from 6 3/4 to 6.5, is there any other tweaks we may want to make to the target? So even though we're 55-45, you know, what sort of tweaks might we make? And, you know, when you look at the table below in the memo, those are some of the changes that you see. Nothing radical, but again, some tweaks to reflect, in their opinion, the experts, that this is more in line, the target's more in line with what a 6.5% return assumption would look like. You know, the other questions you ask yourself, or a board would ask when we look at making these changes is, well, what is the impact on our annual contribution? And what is the impact on our funded ratio? And I reached out to the actuary, and we did look at that. I want to caution, however, that this is based on the 2016 valuation, so we're in the process of updating that valuation. So you may see a different number, you know, at budget time, essentially. But so I want to just touch on that briefly. You'll see the funding requirements. Right now, our ADEC, our actuary determined employer contribution, is $2,049,000. Now, that's not a number you're going to find in the budget. You're going to find part of that in the budget. Probably the best place to find that is if you look at the 2017 audit. On page 59, it talks about OPEB cost and net OPEB obligations. And in 2017, our contributions, which include the actual medical claims, was $2.2 million. So we're still within that. We're still, you know, and again, claims can change, but, you know, if you look at 2017 as kind of a historical guide, you know, we would still be meeting what our ADEC is. And the other thing, when we adopted our OPEB funding policy, we also had a range of funding, you know, try to fund at least 80%, recognizing that the claims could fluctuate. So if we had a good year on claims, you know, we technically have a bad year on contributions because the claims count towards the contributions. The other was the funded ratio, you know, and essentially we were looking at going from 44.1 to 42.7. So, you know, that's really only a marginal change in the funded ratio. Arguably, yes, it does go down a little bit because your liabilities are getting discounted by a smaller number. But that wasn't really deemed to be material. So the bottom line is it's a little bit more conservative. The overall allocation hasn't changed, just the targets. And it shouldn't create a burden in terms of our funding this based on what we funded in the past, which has been the amount that you see in the budget and the amount that's funded through claims. And there's not a material change in the funded ratio. And it's still within our policy in terms of what our OPEB funding strategy is.
And some of this proposed reallocation is to give more flexibility based on the fact that you're lowering the discount rate? Was there any correlation there, or?
Well, if you're asking is, when you look at the asset allocation targets, current and proposed,
Right.
That's directly related, and correct me if I'm wrong, to going from 6 3/4 to
Right.
6.5. So
Right.
I think the question,
Gives them more flexibility based on the fact that you're taking a more conservative approach on the discount rate.
yeah, I was thinking in terms of flexibility, more in terms of just aligning it. So if you're going to lower it to 6.5, what changes would you make to line up with that? And so these are the changes. I mean, the flexibility is still, you know, there to some extent, but these are the targets. So for example, if a new contribution was to come in next month, then if you were to vote for this tonight, then at that snapshot in time, it would be reallocated to what's here. It's
And
it's
this
a little
is done in contemporaneous with what's going on in the market?
bit- Yeah, usually it's the day before's value, I think, is what you
But
use
no,
to
but
run
in
on.
this policy, this
Yes.
proposed reallocation.
Those are the current, using the current capital market assumptions, which are the same that we used earlier this year for the pension. And that's why you'll notice if you kind of look at the trend, as Jim said, these changes are really at the margins, but it's a slight decrease in domestic equity exposure, a slight increase in international and emerging market exposure, just essentially reflecting the relative valuations and the potential over the next number of years for those various asset classes. But it's a relatively minor changes. We're taking a couple of percentage points from the domestic and essentially reallocating it, but we're staying at or proposing staying at the 55% equities, 45% cash and fixed income.
So what does this do to your beta?
It won't change the beta because the beta is versus the benchmark, but it will likely slightly increase the standard deviation or variability of the return.
So it increases risk by a small amount?
Small amount.
Yeah, very, very small amount. It's essentially, it's really unchanged, I would say. It increases your, what's called the VAR, or the value at risk, which is kind of your worst case daily scenario, by 9 basis points. So it's quite, from that point of view, it's pretty negligible. It's really just kind of an adjustment of the allocation to,
So 1/10 of 1%.
Okay, questions on this recommendation?
I got another thought about it, though. Let me see if I'm right. By lowering the interest rate, right, increases the contribution. Lowering the proposed allocation is to offset some of that proposed increase in the pension.
exactly.
Okay. So that means if we propose it less than this, we'll get more increase.
Propose.
Like
Well,
the
if
proposed.
you lower the
Right,
return
if you were to-
assumption, the
if you-
contribution's going to go up. Is that what you're
Right.
saying?
Yeah, so if we were to
Yeah.
go to, say, a 40%
funding
equity,
ratio goes down
60%
even
fixed
further.
income, the contribution will go up further, because now we have kind of offsetting forces. We're getting a little more expected return from the portfolio, but a little less expected return for your discount rate. So they're
Yeah,
offsetting.
right, the offsets up to a little.
Yeah, and again, if you look at page 16 on the OPEB, I just want to underscore again, because I know folks are watching this at home, our 55-45 really isn't changing. If you look on page 16, you'll see 55%, I'm rounding a little bit, in equity, 45% fixed income and other. And then you see all those subcategories. And that's where the tweaks are really happening in those subcategories, so.
I mean, I can say, as from someone who's seen a lot of these and, kind of the course of our daily work, Branford is, especially on the OPEB side, is definitely tends to be a little more conservative than most, and I'll say that for two reasons. For one, because, at 55% in equities, more the norm, at least that I've seen, is closer to 65% in equities for OPEB. But arguably even more significantly is that unlike many municipalities, you're diligent about funding your OPEB, whereas there's an awful lot of OPEB trusts out there that, they're sort of they're
Reaching for it.
yeah, they're funds in name only, and they don't have any money in them. So,
And they have less today.
yeah.
In other words, is our funding ratio pretty high?
Comparatively.
In the OPEB world, it's quite high. I mean, compared to pensions, not so much, but I mean, OPEB's a much sort of,
And so
towns have
40
been
or
funding them, not
41%
nearly
is
as long.
pretty high?
Mr. Finch, where
Yeah.
do we rank?
I would say that there's probably maybe a handful of towns that would have a higher funded ratio than us.
Yeah, and Branford was way ahead of the typical municipality in putting the OPEB in place.
Yeah, so, and just going back to what I said about the 2.2 from the 2017 audit, the contribution that the actuary said was required was $1.9 million. And the contributions made was 2.2. Now, again, some of that's claims and some of that's the money we budget, the 785 and plus the 426,000 from the Board of Ed. that's in our budget, but the rest of it is part of our medical self-insurance, which comes out. So if you look at that's basically a $307,000 over and above what that contribution was. And since the beginning of the program, we're about $718,000 more than what our annual contributions were required. Now, in reality, the funded ratio means more than that, but that goes to their point about communities funding this. Hope's not a strategy. This is something that we're actually trying to do, and we look at how it's invested and we tweak it accordingly, and we take advice from our experts in terms of where the market is and where the declines are and where the rebalancing is, and it's like there's a vector and we try to keep adjusting course. It's like the pilot's adjusting to the course. You might get knocked off a little bit, but you try to get back on the course. So in the end of the day, you land where you're supposed to land.
Okay, I'll read a resolution here and test your will here. Resolve, the Board of Finance authorizes a reduction in the long-term rate of return assumption for the OPEB trust fund from 6.75 to 6.5% for the OPEB trust fund, and recommends changing the trust target asset allocation as follows. And there's a chart here, and I'm just going to read the proposed. Large cap, 14.5%, mid cap, 5.5%, small cap, 5.5%, developed international, 12.5%, emerging markets, 8.5%, U.S. real estate, 8.5%, U.S. investment grade bonds, 36%, U.S. high yield bonds, 8%, and cash, 1%. Somebody want to move that?
Second.
Been moved by Robert.
second it, Joe.
Seconded by Jeff. Additional discussion? All in favor?
Aye.
Thank you, gentlemen.
Thank you.
Great, thank you all.
Next is to consider and, if appropriate, approve a request from Parks and Rec for the following budget transfer for fiscal 2019. Excuse me, and there's from field renovation, $12. These are all from capital accounts to a new capital accounts. Court renovation, $4,350. Fencing, $939. Field renovation, $3,086. Court renovation, $4,000. Fencing, $9,010. Hammerfield roofing, $800. Foot Park roofing, $4,800. Foot Park fencing, $12,700, and Foot Park fencing, $75,000, for a total of $114,697. Transferring into field renovation program, $3,098. Court renovation, $8,350. Field fencing, $9,949. And Foot Park restroom renovations, $93,300, for a total of $114,697. Welcome, Alex.
Good evening. I first would like to just apologize for the lateness of my narrative. I had thought I prepared it and sent it up a month ago, but that was on my end, and I sent it up late today for you to take a look at. I want to break down these into two parts. First, on the first part, which actually takes us away from foot, $21,397 transfer into field renovation, court renovations, and field fencing replacement programs. These are capital items that we have each year, and basically what I was doing is reallocating those dollars into those funds. As you know, we have a lot of use on our fields. This last year we had a little bit more. It was probably the worst fall we've ever had on record. It was 50% wet most of the year. We had to really look at other facilities that we utilized to go on because we weren't able to play on a lot of the fields throughout town. And so it brought a little bit more stress on those fields. So it's just important that we continue to hopefully fund that in the future. You'll see that every year coming back, but we did this maybe about 5 or 6 years ago where we reallocated some funds. So, and I did them all in numerical order on how they appear, and other than the last 3 items, which we'll get to next, if you want to have any questions on that first transfer of $21,397 for those items.
Why don't you keep going, Alex?
Continue, okay. Also, so on the foot park side, again, this past year, we were supposed to do fencing this past fall, but we're actually right now working on a 5-year capital plan with the Foot Trust, and we're looking down the road on to do some major improvements there. We thought at this year that we would be able to take the $75,000 away from the fencing that we were doing on the tennis courts and move that into next year's capital, which was on the foot park restroom renovations. We went out a couple of years ago to take a look at what that would cost. It was in the vicinity of about $80,000 at that time. And I feel comfortable that we should be able to get a good product. And this is the building facility as they come in. We have a men and ladies restrooms, and we want to make them handicap accessible, because currently they are not. We do have one access down there, but it's kind of unilateral. We can't have them both be utilized. That part of the building was is 45 years old, those restrooms, and and as you see in my narrative, you can see all of the changes that we were going to make to them. So we felt it was more important to get that project on the road. Hopefully go out to bid in early spring and get it done by early summer going forward. How we arrived at some of these other dollars, there were savings in costs on original fencing and also some of the roofing. We replaced the roof on that building, and we also replaced all the roofs on the pavilions down there and the playgrounds. And we had some dollars left over, and the same with fencing too. We had done fencing for all of the ball fields. Every ball field is completely redone, new backstops redone, perimeter fencing also done, and we want to move forward with. We had a savings in those dollars of $12,700, so we put all these dollars into that total of $114,697. And just a footnote, I mentioned in my narrative that these dollars are all from Foot Park Trust.
So Alex, you're moving $93,300 into Foot Park restroom, right?
Yes.
But the 3 items, the roofing, fencing, and fencing, it's 90, oh, I see, it's 90, it's 92.5, okay. So you're moving more than what you're taking out of the trust funds.
800 out of the Hammerfield roofing, it looks like.
Okay,
I think that's
Right.
the difference, yeah.
yes,
So,
all right,
Thank you, Jamie.
thanks. Okay, questions on Alex, Charlie?
Alex, as I read this, so 93,300 is all foot funds, no town funds.
Except for the $300, yes.
How about the 21,397? Those are town funds?
Yes.
Okay, and those are from a transfer of other line items?
Other line item accounts, which pretty much are mostly either field renovation or court renovation over the years.
Okay,
We kind of reallocate going forward down the road after a bunch of years.
got it.
So that's from the $12.40 down to the $91.10. That's the 21,000 you're referring to.
Yeah, okay.
Yes. Actually, down to the Hammerfield roofing, I apologize. Joe, you mentioned down to the field fencing, down to the Hammerfield roofing.
Right, okay.
800.
But as Jamie pointed out, you took some of that money and put it into your Foot Park.
Yeah, the
account.
300 is what I think. I thought you mentioned, I'm sorry.
800. 'Cause you're
Okay.
at 92,000 a foot more.
Yes.
92.5.
Don't try to pull a fast one on us.
Correct, no, I got it.
And then you're taking $800 of town side.
Town
Yeah.
side out,
That's
yes.
going. And so you had all this fencing you were going to do down there, but you're going to delay that or reschedule?
We're going to delay that into the following year. We're still putting together, we've put together a 5-year plan, and we're working with the Foot Trust at this point. And because now it's the end of the year and we have to apply again for our dollars for next year as we do every year. This is the time that we get it in at the end of the month, and then we hear somewhere in February of what we get going forward. And it's been $200,000 over the last 3 years since we've taken it over.
Thanks, Alex. Charlie, you got another question?
Yeah, of the 93.3, which you said is trust funds, is there any balance in the trust funds?
Minus the 800.
Oh, that's it, okay, got it.
Yeah.
All right. So you're going to get that next year from the fund?
We expect to, yes.
Okay.
Okay.
I'll move it.
Moved by Robert,
Second.
second by Victor. Discussion. All in favor?
Aye.
Thank Alex. Good
Thank
luck.
you.
Next, number 8 is to consider and, if appropriate, approve a request and following transfer pursuant to the collective bargaining agreement for the supervisors union. And I'll read this. It's from contingency 48,543. This is for fiscal 19. And going into fiscal wage, this is all wages and salaries. Fiscal services, 4378, planning, 5263, assessor, 4340, engineering, 5466, solid waste, 3176, building, 4214, animal control, $3,030, elderly services, $4,423, Willoughby Wallace, $4,169, recreation, $3289, public works, $3314, and inland wetlands, $3,481, for a total of $48,543. And those are for current adjustments and for retro wages per the settlement as well. Again, out of contingency, $23,984. Going into retro wages for fiscal services, $2163, planning, $2,600, assessor, $2,143, engineering, $2,704, solid waste, $1,560, building, $2,080, animal control, $1,496, elderly services, $2,184, Willoughby Wallace, $2,060, recreation, $1,623, public works, $1,644, and inland wetlands, $1,727, for a total of $23,984. There's a corresponding transfer to the other funds of transfer into animal control, $4526, and expenditures of $4526. So those are the three requests, transfers. Jim or Jamie, you'd like to go over the highlights of the settlement?
Yeah, essentially, it was a 4-year agreement. It's 2.5% per year, which is consistent with the other labor contracts. There were changes on the medical side, as was consistent with the other, increasing premium shares, increasing the deductibles and the HSAs, and also increasing the amount that the town funds. And the other thing that I know Lisa provided the link to that, and I mentioned it in a letter, but on page 11 of the contract, basically it allows for folks to get, basically somebody would get hired at potentially 80% of what the current rates are, although the first selectman can deviate from that, based on someone's experience, et cetera. So, it does give some flexibility. Some of the other bargaining units, folks start out lower. So that is something that was not in the current contract. So like maybe if somebody was an assistant and they became, that department head, there might be, it's quite possible that this part of the contract would be invoked and they would get funded at, say, a percentage of what that job pays, and then over a series of years would actually eventually catch up. So it's almost like creating like ranges, basically, or steps, rather.
What's the probationary period for these positions?
I would have to, I will tell you in a second. It looks like,
150 calendar days?
yeah, it looks, that's what I'm seeing, yep.
Yeah, okay.
And then you could extend the probationary period, so. And then there's different, it's all on page 7, they talk about different
Yeah, I
aspects
see
of
it.
it, then there's transfers, et cetera.
Yep, thanks. Questions on this?
Jim, on the union dues, do they pay different, does everybody pay the same amount?
No, throughout the town, there's different bargaining groups, and they have different dues. For example, the supervisors is American Federation of State, County, Municipal Employees, ASME. Other ones belong to different groups.
Yeah.
And, you know, I'm not in the union, so I don't really know exactly how the dues are set, but typically it's the group that represents them, right? And maybe there is some input on the local side. I'm not familiar with it. I know that, you know, dues and agency fees, and again, I'm not an expert on this, but that was sort of the basis of the recent Supreme Court case in terms of what dollars are raised and what they can be used for, so.
I just wonder if they change every year, because it's a 3-year.
Well, whatever it is the dues are actually paid by the members, so the town doesn't participate in that.
Yeah, I know that, but I
Yeah.
just wondered if they, they change the amount of the dues per the year, each year.
I would generally say yes, I don't know how much, but I suspect they're all different.
Okay, thanks.
Okay.
I'll move it, Joe.
Moved by Jeff, the 3 transfers.
Second it.
Motion been moved and seconded. Just a question, this has been approved by the RTM?
Yes.
All in favor?
Aye.
Thank you. Next is item number 9, to consider and act upon the following proposed resolution. Resolution amending a resolution appropriating $2.1 million for Harbor Street culvert improvements and authorizing the issuance of $2,100,000 worth of bonds of the town to meet said appropriation and pending the issuance thereof and making temporary borrowings for such purpose. The purpose of the amendment is to increase the appropriation and bond authorization from $2,000,001 to $2,000,002, and ratify, confirm, and adopt all prior resolutions and authorizations in conjunction herewithin, and recommend the resolution for adoption to the RTM. Jim, you want to cover
Yeah,
this?
essentially what we're doing here is we're amending that last authorization, the 2.1 to 2.2, so it's an increase of $100,000. Obviously, we're only going to spend what we need to spend, but one of the things that the state is requiring is, as part of their agreement with the town, is proof of the local authorization, and we're a little bit short based on, you know, the newest estimates. So this does a couple things. One, it allows us, you know, assuming you approve this and the RTM approves it, you know, when we send a completed application up to the state for its grant share, which is currently, as referenced in the resolution, estimated to be about $1,021,000. So they want to make sure that we have our share authorized, and we're a little bit short. So this will fulfill that. You may ask, well, why is this happening now? You may recall back in January, the then town engineer, Janice Blazak, was here, and she had explained to the Board of Finance that the state had basically put this funding on hold. And the Board of Finance made the recommendation that we should, you know, go ahead with the project anyway, because whether the state funds it or not, the project still needs to be done. And so I think in sort of the good news is that essentially, you know, that funding has been freed up, so that $1,021,000 is now available. In terms of the overall project where we stand currently, as it said in the resolution, if you adopt this tonight, the project becomes a $2,250,000 project. We've issued debt of about $1,030,000 so far, so our books already reflect about $1,030,000. You look at the grant of $1,021,000, and the grant could be less if we spend less. So, this is still pro forma, and which basically leaves us a balance to fund of about $199,000. If we were to need the full $250,000 when it's all said and done, and all the last change orders are done, punch list items are done. So essentially, this small increase in the authorization allows us to complete our application through the local bridge program, which again is good news because 9 months ago, 10 months ago, we weren't sure we were going to get any funding, and that means that we would have very little to issue for this project other than what's already been issued. So I think on balance, from a funding perspective, I think we're in a pretty good place. From an engineering perspective, I don't know much about culverts except that it's a span between one site and another, and the folks that live in that area will probably be very happy when it's completed. So,
Charlie?
It's probably me, but when the resolution says amending from 2.1 to 2.1.
Yeah, I had the same question. Sure it shouldn't read 2.2?
Yeah.
where?
Anywhere.
But the resolution itself says amending it from 2.1 to 2.1. And down below, it says up to 2.2.
Yeah, I mean,
That's
I think
consistent.
it's referencing the earlier 2.1. Are you talking about section 1?
I'm talking about the resolution.
Yeah, I know. What's-
They're referring to the old resolution.
It's the old resolution.
Yeah, it's referencing the old resolution at 2.1.
Oh, the older resolution.
You
Right.
get into it, it goes to 2.2.
Okay, so you're
Then you go to
just,
section
So you're
2.
replacing it with the 2.2 or 2.2.
Right.
Section 2.
Yeah, they do get confusing, but they spend a lot of time referencing the old one because the old one, the original one had all that other language in there, about, those are usually like 3
What happens
pages.
is by us not reading the entire resolution, we lose the context.
Oh, yeah, I
when
guess.
That's
Okay.
really what it is.
Okay, yeah, that's fair.
That's that's essentially, if we're just taking the shortcut, then we don't
Yeah,
get,
all right.
we don't get the 2.2.
all right.
I'll move it, Joe.
I'll second it.
Okay, so it's been moved and seconded. I did read it previously, so I think we're good to go. Any, pardon? Pardon?
Yeah, you want to waive
You want to waive? Did you say you wanted to waive?
Yeah, I'll second. I'll move to waive the reading of the entire resolution. And Jeff just seconded.
I'm happy to read it, Jeff seconded, discussion? All in favor?
Right.
Aye.
Okay.
I have a post question. Does anybody know what's happened to the Sybil Creek culvert? Is that still on the schedule?
Yeah, that's,
state project, right?
yeah, state project. I believe that's scheduled for next fall. It did slide a little bit more, but
It's been delayed at least a year, I think, right?
Oh, yeah.
More than that.
I think they're scheduled to advertise for bid end of this summer. Yeah.
Thank you.
Do we need any more votes? We're all set on,
So we waived the full
We
reading.
waived the full- yep.
And who made the motion on the,
Bob.
okay, Bob, and
Second
seconded
by
by
Victor.
Vic?
second by
Okay.
Victor, and we had some discussion. We just redo the all in favor on that one?
Aye.
Aye.
Okay. So I think we're good, even though the sequence isn't perfect. Very good. Okay, next, number 10 is to consider actions to assist the first selectman in hiring a director of human resources. Jamie?
Okay. So, as you know, the director position for Human Resources Department is currently vacant, as well as the assistant director position. That duty has been being fulfilled by our former HR Director Joyce Forty. However, we're at the point where we're going out and we've to the market and try to get a candidate to fulfill those critical positions. Just to go back a little bit, talk about the history, when Joyce had first left, that position was, I think in mid-90s, around $95,000 for that position. We had put in the budget that it should be, that salary, considering all the responsibilities that fall under the Director of Human Resources, that it ought to be increased to $105,000. Through the budget process, that was then reduced down to back into the $90,000, $95,000 range. We did fill the position. With the applicants that we received, the experience, we ended up hiring at the lower range of the, for the salary. And that's why that current position is budgeted in the current year budget of $84,050, which is a lower range for the, not only you just approved the supervisor's contract for department heads within town, but also compared to other Director of Human Resources in comparable towns to Branford. We are now going through some applicants, did some interviews. We have really a qualified candidate, and we'd like to really fully staff that department. However, recognizing that that salary that's currently budgeted is low, I'd like some flexibility to staying within the overall budget of the unaffiliated positions and part-time positions that are within that department, to kind of move some money around so we could be at a competitive salary for that position. As I said, there's it's currently $84,000. Within that department, we have just over $60,000 for the assistant HR director. And you may recall this budget season, we had a line item in there of $25,350 for a part-time position. However, we feel evaluating the position, the responsibilities, working within that, let's refer to as a salary cap of the $169,543, that we can make some adjustments to really fill those positions with some very qualified candidates, both HR director and then eventually the assistant director. So this request wouldn't have any overall budget implications other than making some adjustments within those unaffiliated positions.
So while this is not looking for a transfer, it's looking for guidance, because we've, over the years, have had policy that, number one, we ordinarily wouldn't add a position, or we were fairly, we're line item budgeted, even though right now the salary items are somewhat compressed. That, again, this has implications going forward if, in fact, they're hiring at a different rate than what we had budgeted previously.
Right. So, I mean, where we are with the budget being, mid-year through the budget, we could certainly hire somebody at a competitive salary what the market should bear right now. However, I wanted to come before the board because, it will have future budget implications if we bring somebody on board, still operating within that budget.
So a draft resolution that we've worth for consideration is resolved that the Board of Finance authorizes the first selectman to hire a director of human resources for an amount greater than the amount budgeted for that position, provided the hire does not cause the total of all the salary and wage accounts to exceed the budget. This gives Jamie some flexibility to, again, hire an appropriate person and stay within the budget for the fiscal year and have, I guess, reasonable impact on future years, because You're still looking at the total of those three accounts, the 169,000?
Yeah, so I'm looking at that as, other than the,
The risk management.
right.
Yeah, and the benefits would be different if it was no longer part-time. That
Right.
piece would-
Got it.
But we're not looking at,
No, I just, that's.
we're not looking to add any new positions. These are currently all budgeted positions. We just want to have some flexibility with the dollars that are, as you mentioned, Joe, in that specific line item for each of those positions. So, going next, other than to say that a normal general wage increase that occurs with a new budget, there wouldn't be any budget impact for future years.
Right, thank you. Questions?
Jamie, is there anybody filling that office now?
Yes, so Joyce Forty is still.
Oh, she is?
Yes, yes.
Part-time.
Part-time.
All right.
I'll move this.
I'll move it.
Oh,
Pete?
I'll second it.
Been moved and seconded. Discussion? All in favor?
Aye.
Good luck, Jamie, on that.
Yeah.
And
I'll move the proposed meeting schedule.
thank you. Okay, so, thank you, Victor. Number 11 is this meeting schedule, and Victor's moved it. The only change, other than ordinarily the last Monday of the month, was September. As you know, due to Rosh Hashanah, Rosh Hashanah, and then in May, moving backwards, Memorial Day, adjustment for that. Budget meetings in March, beginning on the 18th. You've moved it. Did somebody second that?
I'll second it.
Bob seconded. In discussion, questions, issues? All in favor? Aye. And the last thing, even though it's not on the agenda, I just thought informally Jamie might provide a brief update on the Blackstone Library. I know they came last month and said they're pretty much on target. Just didn't know if you had an update.
Yes, thanks, Joe. So the Blackstone, I believe when they updated you last month, they let you know that there were a few packages that they were going to go back out to bid. So between rebidding some packages, value engineering, some items, as well as some scope reductions, they now have a project that's within the original appropriation of this board, so they are able to move forward. And also, you may have heard that they did reach their capital campaign goal of $800,000. They did receive another grant through the Greater New Haven Foundation for $75,000. So that's what put them over the top of their $800,000 capital campaign. So they do expect to have a groundbreaking, I believe, December 6th, and get the project underway.
Great.
Great news.
Okay, thank you. And with no other business to come before the board, I'll entertain a motion for adjournment.
So moved.
Moved and
Second.
seconded. All in favor?
Aye.
Thank you.
This program was brought to you in part through the support of the Town of Branford. Watch town meetings and other videos on demand at BranfordTV.org.